Hello and welcome to the November 19th, 2021 version of News from the Front Lines of Business by DW Huff Consulting, where we help you know your numbers so that you can grow your numbers. And one disclaimer here is that we're going to be discussing some financial topics and tax savings topics, and just keep in mind that as usual, these pieces of information are given to you for educational purposes and they're not intended to be a specific recommendation or advice to you. Definitely seek out your own counsel before acting on anything you've learned here today. Okay, welcome to this week's edition. Kind of a quiet week, but one I guess note here is that we are about to get a shutdown in the electronic filing from the IRS. So any personal returns that are still out there, we're going to try to get done before this Saturday's deadline kind of ends here. But now, I guess our fun with the numbers for this week, with Thanksgiving coming up, is 1.5. And what the 1.5 represents is the suggested amount of turkey you should get per person. So depending on, what other side dishes you have, look at the number of people there and figure out how big of a turkey you should get, or how many turkeys you should get. And I guess if you having trouble with these supply chain issues that we're seeing and you can't get enough turkeys, I guess you got to factor in some ham or something else. But anyway, I thought that was an interesting number for us here as we come into our Thanksgiving week break here. So, all right, so on our news here, like I said, it's kind of quiet, but we've had a couple of things in the news. There's some elections last week that caused a little update to the Louisiana tax rates. So that's interesting. And also we had a couple discussions over the past week regarding some real estate investment questions and a lot of detailed conversations on some different strategies. Like we've talked a lot about the self-directed IRAs, where you can hold properties there and not have gains, but there's an alternative method which is called refi till you die, where you keep the properties outside of these qualified accounts, and as they go up in value you refi and kind of do these cash out refis. And there's an illustration here, and I guess why that's an advantage when you review historical versus nominal dollars. So with that, let's just kind of dive into that part of the discussion. So we know most time real estate is held for a long time. Consider the case of your home, let's say. And if it has, just thinking back, like in that case of my parents. So if you go back, 30 or 40 years ago when they first bought their house, I can remember here in St. Bernard Parish, they bought a house for $30,000 in 1975. All right, so that same house now, $150,000, somewhere along there. And the reason why is because inflation, right? So the property didn't really go up in value that much. And the reason, I guess, to explain that is how inflation affects things. So we need to get kind of comfortable with this term here of nominal numbers versus inflation adjusted numbers. So on a situation like that, we have a long-term mortgage. If inflation kind of stays in line with what it's historically been, you paying back that investor over the long, that payment at 30 years down the line from when you first got the loan is worth a heck of a lot less than it was when you first got the house. So I guess that's the reason why, and I guess the underlying reason, if you're at work and you're doing a job, it may have been hard to make those mortgage payments the first year, but as inflation comes into play, assuming that you've gotten raises every year to at least stay up with inflation, but you notice that the dollar amount of the loan payment doesn't change. So let's just say, if round numbers, if you had a $100 a month note on that $30,000 house way back when, in 1975, that dollar was pretty hard to come by back then. But as 30 years worth of inflation have come into play, you may have gotten raises over the course of that time. So that dollar, if you look at it in purchasing power, it might have dropped down to purchasing power of 50 cents. So you're making more money, but you're still making the note payment based on whatever you agreed on back at that long time, historical dollar amount in the past. So look at it. They show a couple examples here, different nominal interest rates. So in the case here, they're using 10% as a rate, and when you subtract out the interest, who wins, the creditor or the guy who lent out the money? So if the inflation rate in this first line here, if it's 5%, which is a little bit higher than historical average, in a case like that, the creditor wins because inflation goes up 5% every year. Your wages go up at that same amount, but your payment stays the same. So the interest rate is not doing as much good for that person who lent the money out as it did in the early part of the loan. And if it's a 10% rate, it's a draw. And if somehow inflation gets really, really high, then the debtor can really pull out ahead. So if it stays kind of how they think it's going to be, creditor wins. If it goes up a little bit, it's a draw. And if it really gets out of control, the debtor can win big time. And this is something that you see in government monetary policy as well. Governments have to repay those government bonds that they issue to people, and they have the ability to control inflation by their printing of money. So think about how unfair that is. That you get a loan payment here, you run inflation up past 15 and 20%, and now those people are paying you back based on those old historical low numbers, based on their inflation adjusted earnings, and it's a pretty good way to get rid of debt. So you wonder why they tax anybody at all when they can inflate their debt away like they can. I guess in another example, it kind of just illustrates a little bit more about how nominal versus historical costs affect things. Is this example here with the price of an egg. So I know there's a couple other things going on in this slide here, but I would just say look at the purchase price there of eggs. So we have a column here for 1970, 80, 90, 2000, and 2010. The nominal amount, that's the amount you actually pay. So back in 1970, you paid 61 cents. 2010, you paid $1.54. However, that $1.54 is not worth the same thing. So when you look at the row below it down here, when you're talking about it's labeled the real prices, in 1970, that's our base year there, so the 61 cents is accurate. But in 1980, it's only 40 cents, and then it goes down to 30 cents in 1990, 21 cents in 2000, 27 cents in 2010. So really, the price of the eggs in real numbers, when you're comparing that dollar purchasing power versus now versus then, it's only in inflation adjusted dollars only 27 cents. So the eggs, I guess, because technology of harvesting the eggs and whatnot is probably improved, and it's easier and faster to store those things. So now the cost is on a real rate has gone down. I guess now, well, I know we just want to look at the eggs in that situation, but when you take a look at the cost of a college education, you can see that kind of the opposite has happened there. So regardless of what kind of technology we have, remote learning, and all that kind of stuff, you see that the cost on a real basis there, 1970, 2112 versus 2010, 3835, and it's probably even worse than that now in 2021. But I think it's a pretty good example just of how things kind of flow, and just just because you're paying a larger number of dollars, since those dollars aren't worth as much, you're really not worse off. So interesting observation. And we'll talk about that. And we did mention too about the refi to your die and other things on the real estate considerations, tax-wise, and all that consider other than just your historical costs. But plenty to think about there when you're making investment decisions. And I think what that kind of points you to is in most cases with these real estate deals, since leverage is so easily available with banks and different lending institutions, you have a hard time justifying paying cash for any property, whether you can or you can't, because of this situation where as time goes on, those dollars are worth less. So you seems like most of the time, depending on what the interest rate is, you're better off borrowing as high amount as you can and paying it down the line with dollars that are worth a lot less when you adjust for inflation. Okay, so last week we also had some excitement. Not really exciting. There was an election, and they voted for some local politicians on the different chambers in Orleans Parish and some other things that were statewide. One thing it did not pass was this sales tax simplification, so we won't bother talking about it. But they did change the tax rate. So on the right-hand side here, we see there's two different tax tables. The one on top is for individuals, and you'll notice that it's a little bit lower than it was before. So the old bracket it used to be 246. Now it's 1.85, 3.5 in the middle bracket, and 4.25 at the highest. And everything seems the same. So on its face, it looks like everybody should be paying less tax. And this graph kind of plays out and shows you that example. And in these examples, everybody does pay less tax. So they got an example of a person making 20, 40, 49, 80, and $100,000 in each one of these columns. And these are all pretty common scenarios, I think, with the majority of taxpayers, I guess, when you shake it out. And in each of those cases, people pay less. So I think across the board, the people in the middle income and to lower income side of things are definitely going to see a savings there. But the higher brackets will be affected differently. So they don't show that here, but one of the changes is that when you calculate how much Louisiana income is taxable, you start with it the same way you do everything else, but you add all your income sources together. And on the federal side, you take out some deductions there with the itemized and the standard deduction and whatnot, and you come up with a taxable income number, and it generates some dollar amount of federal tax. The way it used to be prior to this act is that when you go to calculate your Louisiana income, you subtract your federal income tax from that number, and then whatever's left over is subject to Louisiana tax. So if you're in a very high tax bracket, you're getting a big deduction on your Louisiana taxable income. This act kind of changes that. So for most people, it's okay, but for the higher earners, they're going to notice their state tax is going to be going up. And I guess the reason why is that the state likes this better is it stabilizes their income. So we know the tax code change on the federal side happen pretty regularly, and sometimes those things cause a savings for people on federal taxes. And when that happens, whether it's a savings or an increase, whatever it is, it affects Louisiana's rates negatively sometimes, and they want to have a more steady so this basically decouples Louisiana from having to worry about what your federal tax is, because now it's just the Louisiana taxable income times the rate, and there's no deduction for federal taxes anymore. So that's a kind of a new change. So alright, so that's about it for this week, guys. So my thought for the week is memento mori. So that's comes to me as one of my Stoic readings here. Is basically, in loosely translated, means remember death. As we're here dealing with the passing away of my dog Dan, Nina Huff. Poor thing came down with cancer, and we had to put her down this week, and that got me kind of bummed out the whole week. But it does remember us to go out and live our life like it's our last, basically, and prepare our minds in such a way so don't postpone things. Balance your books every day. This is a quote from Seneca where he kind of expands on that memento mori philosophy there, and basically because it tells you to get out there and don't postpone things that you know you need to do and you want to do, particularly when you're talking about other people in your life. So that kind of rings true for me. Just kind of cleaning up some of her stuff as she passed away, and like the food bowl and things like that. So things that were there and she was just using like a day before are now not being used and being put away. So just you could be gone tomorrow, there's another term you see it with a lot of these philosophers. So with that, I will wish everybody a happy weekend here, and we'll see you next week. Probably. It's Thanksgiving week, so I'm not sure if we'll be doing very much Friday, but we'll see. If I show up for work, we'll record something. If not, I'll see you the week after. Have a good weekend.